On today's episode, we have infighting with two of the largest lending powerhouses. Meanwhile, we have a huge investment firm buying up home builders and the subsidiaries that make it all work. What does all this mean for the near future of real estate and the housing market? We talk about all that, and I fill you in on current rates. My name is Mark. Welcome to the Gentleman Broker Mortgage Brief. Let's start with the drama. Rocket, through its acquisition of Mr. Cooper, is suing UWM for nearly $100 million, alleging UWM sold servicing rights on about 182,000 loans, totaling roughly $65 billion in unpaid balances. Then later turned around and actively tried to refinance those same borrowers back through the broker channel. Who is Rocket? And who is UWM? Rocket is the largest direct-to-consumer mortgage lender in America. It was originally known as Quicken Loans. Their model is built around technology, online applications, massive marketing, and working directly with consumers. Rocket also has a wholesale channel, but its brand is primarily consumer-facing. UWM is the largest wholesale mortgage lender in America. UWM does not primarily market to consumers. Instead, they provide the money, underwriting, and technology that independent mortgage brokers use to originate loans. And this is one of the biggest mortgage industry fights in years. And it's not really about retail versus wholesale. It's about mortgage servicing rights and who owns the right to market to those borrowers. Rocket's argument is this. You sold us the servicing rights and agreed not to solicit those borrowers. Then you solicited them anyway. So why is Rocket so upset? When a servicing company buys the rights, they're buying future income from monthly servicing fees, escrow administration, customer retention opportunities, future refinance opportunities. If borrowers refinance away quickly, the servicing assets lose value. Rocket claims the loans in question prepaid at roughly 2.5 times the rate of comparable loan pools, causing nearly $100 million in damages. All right, what specifically does Rocket say UWM did? According to the complaint, UWM sold the servicing rights to Mr. Cooper in 2024. The sale agreement allegedly contained non-solicitation provisions. UWM later launched programs including Refi 75, which is a refinance incentive program, Keep, an AI-driven refinance targeting platform. And Rocket alleges those programs targeted borrowers whose servicing rights had already been sold. Rocket even characterizes parts of the strategy as putting a bounty on those loans. So why do we care about any of this? This case isn't really about whether brokers can market to past clients. The key question is, can a lender sell servicing rights and then use its broker network to target those exact borrowers if the sale contract says they won't? If Rocket wins, MCR sale agreements could become much stricter. Lenders may put tighter restrictions on post-sale borrowing marketing. MSR values could increase because buyers would have stronger protections. If UWM wins, it could reinforce the ability of lenders and brokers to continue marketing to prior clients even after servicing is transferred, depending on contract language. The lawsuit isn't really about rates or loan programs. It's about who owns the customer relationship after a loan closes. As rates eventually fall, that relationship could be worth billions across the mortgage industry. That's the real significance of this fight. It's a preview of the refinance battle everyone expects once the rates move lower. I'm interested in knowing your perspective. How do you think all this will affect the lending industry? While we are focused on large companies making power moves, Berkshire Hathaway has just agreed to buy home builder Taylor Morrison for an approximate $8.5 billion, including debt. Berkshire is paying $72.50 per share, which is a 24% premium over the stock's prior closing price. This is the first major acquisition under Berkshire CEO Greg Abel since taking over from Warren Buffett. So why does this matter? We know Berkshire makes slow and calculated moves. For years, Berkshire has been quietly building a housing empire. Clayton Homes, manufactured housing; Home Services of America, real estate brokerage; Benjamin Moore Paint; and Johns Manville, which is building products. Acquiring Taylor Morrison gives Berkshire a major site-built home builder and deepens its footprint across nearly every stage of housing. This is the signal I believe Berkshire is sending. Berkshire believes the long-term housing shortage in the U.S. outweighs the current slowdown. They believe that the housing remains attractive at current valuations. And even though we have affordability challenges, the market is reading this as a vote of confidence in housing. One of the most successful investment firms spends $8.5 billion buying a home builder during a difficult market. They aren't betting on next month. They're betting on the next decade. Berkshire's move suggests they believe housing demand and home ownership remain strong long term, despite the affordability challenges we're seeing today. If Berkshire Hathaway is deploying billions right now into home building, what does that tell us about where smart money thinks housing will be in the next 3 to 5 years? As we start this week, we look at current mortgage rates. The average 30-year fixed is sitting at around 6.48%. And of course, I will leave you with this quote by Benjamin Franklin: "An investment in knowledge pays the best interest." This has been your mortgage brief for the week. For everyone watching, I hope today is the start of a productive week. I hope you are proud of the work you are doing. My name is Mark, and I am the Gentleman Broker.